Silver didn't just spike, it broke the rules. In one trading session, the price launched straight up, tagged roughly $117 an ounce, then collapsed almost $10 within hours. That's the paradox. A historic surge and a violent rejection happening at the same time. And if you think this is just chart drama for traders, it isn't. Moves like this ripple outward. They change how money behaves, how risk spreads, and how fast confidence can disappear. The record shows silver logged its biggest single-day gain since the mid-1980s, jumping more than 10% intraday after holding steady overnight near the low 100s. Then came the reversal. Heavy volume on the way up, heavy volume on the way down. But here's the part nobody is saying out loud. Markets only move like this when something underneath is under stress. Not emotion, structure, leverage colliding with limits. And when that collision happens, the first shock is never the last. Because the real danger isn't the spike you saw. It's what this kind of move quietly unlocks next. What actually happened here didn't start at the top. It started much earlier and much quieter. Silver wasn't drifting aimlessly before this move. It was sitting calmly overnight, trading in a tight band just above 108, barely attracting attention. Then suddenly, volume surged. Price didn't climb, it accelerated. Within a single session, silver added roughly $13 to $15, pushing into territory it hadn't touched in decades. That alone would have been notable, but this wasn't a clean breakout. It was a blow-off. The kind of move that compresses weeks of buying into hours, then forces the market to make a decision immediately. And notice what's missing from the mainstream explanation. There was no single announcement, no policy change, no clean headline that justifies that kind of vertical move, which raises the real framing question. If nothing new caused this, why did it happen now? Because this wasn't an isolated spike. It fits a broader pattern of market snapping as pressure builds invisibly. Assets don't move like this when conditions are healthy. They move like this when stress has been accumulating and suddenly finds an exit. And once that pattern appears, it rarely stays contained to one asset. Here's the claim that makes this move different. This wasn't just enthusiasm, it was exhaustion showing up in real time. The data shows that during the surge, silver pushed into extreme overbought territory, with short-term momentum readings reaching levels rarely sustained. On a 4-hour window, the RSI stretched into the high 80s. That's not strength. That's strain. Historically, when momentum reaches that zone, the market isn't asking whether to pull back, it's deciding how violently, and the price action confirms it. As silver ripped toward the 117 area, volume didn't fade. It expanded. Then, on the reversal, volume expanded again. That tells you both sides were fully engaged, aggressive buyers rushing in, aggressive sellers hitting the same price zone. But notice what they didn't deny. No one stepped in to defend those highs. There was no pause, no consolidation, just rejection. That implies the move ran into a level where profit-taking and automated selling overwhelmed fresh demand. This is where the story flips. Because when a market climbs vertically without building support underneath, every dollar higher increases fragility. The gains look powerful, but they're sitting on air. And when that air escapes, prices don't drift down, they snap. What looks like strength on the chart can actually be a warning that the market has gone too far too fast. And when that happens, the next phase isn't about optimism, it's about control. After the rejection, the situation didn't calm down. It normalized something that shouldn't feel normal at all. A $10 swing in silver in hours is not routine behavior, yet it was absorbed almost instantly, treated as just another volatile session. That's escalation. When markets begin to accept extreme moves as ordinary, it means participants are being conditioned to instability. We've seen this pattern before. Late-stage cycles don't end quietly. They end with sharp surges, sudden reversals, and repeated attempts to push higher that fail faster each time. The climb into the 100 teens followed a near vertical path, erasing traditional support levels along the way. That matters because support isn't just a line on a chart, it's memory. It's where buyers previously proved they were willing to step in. When price bypasses those areas too quickly, there's nothing underneath to slow a fall. Here's why that detail changes everything. Once volatility becomes the baseline, decision-making shifts. Longs become quicker to take profits, shorts become more aggressive at key levels, algorithms tighten their thresholds. The market becomes jumpy, reactive, and unforgiving. What began as a powerful rally quietly transforms into a test of whether confidence can survive repeated shocks. And the more often price whipsaws like this, the harder it becomes to rebuild trust before the next move forces the issue again. The next layer is more uncomfortable because it exposes a contradiction. While the price was exploding on screen, the structure underneath was tightening. Much of the activity driving the surge wasn't physical metal changing hands, it was paper exposure, futures, leveraged products, and silver-linked ETFs amplified the move on the way up and then amplified the damage on the way down. When margins were raised, the cost of holding those positions jumped overnight. That's not theory, that's pressure, and pressure forces behavior. Traders who were positioned for continuation suddenly had to either add capital or reduce exposure. Many chose to exit. At the same time, short sellers who had been leaning against the rally were being squeezed as price accelerated, only to find relief once the reversal hit. Notice the contradiction. Publicly, the narrative was unstoppable momentum. Privately, risk controls were tightening and leverage was being flushed. This is where perception and reality split. On the surface, silver looked powerful. Underneath, the market was becoming more fragile by the hour. Here's the line that permanently changes how this move should be viewed. A rally driven primarily by leverage doesn't need bad news to reverse. It only needs conditions to stop getting easier. And once that happens, the same mechanisms that pushed price up become the mechanisms that pull it down faster than most participants expect. Then the pressure started stacking, not in one dramatic headline, but in quick succession. Margins go up, volatility spikes, price fails to hold the highs. Each on its own is manageable. Together they compress time. Moves that normally play out over weeks get forced into days, sometimes hours. That's when control slips. Positions that were comfortable suddenly aren't. Stops get tighter. Conviction weakens. And liquidity starts thinning exactly when it's needed most. Now watch how fast this escalates. A market that just proved it can swing $10 in a session doesn't need a catalyst to keep swinging. It already trained participants to expect instability. That expectation feeds back into behavior. Traders hesitate to hold overnight. Algorithms react faster. Small moves trigger outsized responses. This is how volatility becomes self-reinforcing. And here's the quiet risk. When everyone is watching price, fewer people are watching structure. But structure is what determines whether the next move is contained or cascading. The question isn't whether silver can bounce after a pullback. The question is whether the system around it can handle another shock without something snapping. What happens if this continues? Now bring this back to you because this is where abstract market moves turn into real-world impact. When silver whipsaws like this, it doesn't stay confined to a chart. Volatility changes behavior everywhere else. Prices at dealers adjust faster, spreads widen, products disappear, then reappear at higher premiums. What looked affordable last week suddenly isn't, even if the headline price pulls back. And if you're not actively trading, you still feel it indirectly. These moves signal instability in the pricing of money itself. When a hard asset can jump double digits in hours, it's not just speculation reacting, it's confidence recalibrating. That affects savings, long-term planning, and how people think about what stable even means. This is why these moments matter beyond finance circles. They change expectations. People stop trusting smooth lines and start preparing for jolts. Notice how quickly conversations shift from opportunity to protection. That shift doesn't reverse easily, and once it sets in, every pullback feels temporary. Every bounce feels urgent. If this feels familiar, say so in the comments, because this isn't just about silver. It's about how quickly uncertainty is becoming the default setting. To understand why this keeps happening, you have to step back from the price and look at the system that allows it. Modern markets reward speed, leverage, and spectacle. Capital doesn't wait patiently anymore. It rushes toward whatever feels like safety or momentum, then rushes away just as fast. Silver sits at a pressure point in that system. It's small enough to move violently, but symbolic enough to attract fear-driven money. When confidence in paper promises weakens even slightly, flows concentrate into assets that can't be printed. But here's the unsettling insight. The system isn't built to absorb that shift smoothly. Too much capital is stacked on too few real assets. So instead of orderly repricing, you get spikes and air pockets. This isn't manipulation or madness. It's incentive design. Leverage magnifies moves. Algorithms chase volatility. Media amplifies extremes. And each cycle trains participants to react faster next time. This is why these swings feel bigger and more frequent. The structure itself is brittle. And in brittle systems, stress doesn't dissipate. It transfers, which means the question isn't whether silver calms down. It's where the pressure goes next when it moves again. From here, the path forward splits, and neither option is calm. One path is consolidation. Price pulls back, tests the psychological $100 zone, and stabilizes as excess leverage is shaken out. That would look like relief, but notice what it would actually signal: that silver has reset at levels that were unthinkable not long ago, turning old resistance into a new floor. The other path is more volatile. If price reclaims the highs too quickly, it risks repeating the same pattern faster and harder. Another surge, another rejection, another round of stress. This is where the story flips again, because both paths point to the same underlying reality. The system is already in motion. Momentum has been awakened, and momentum doesn't need certainty to keep moving. It feeds on unresolved tension. Right now, that tension is everywhere. Debt, currency confidence, political instability, and the shrinking pool of assets perceived as real. The next move doesn't need to be dramatic to matter. It just needs to confirm direction. And once that confirmation arrives, capital won't wait for permission. It will already be repositioning. What this moment reveals is simple and uncomfortable. Silver didn't misbehave. It behaved exactly as a stress system would force it to. A violent rise, a sharp rejection, and a refusal to return to where it came from. That pattern tells you more than any prediction ever could. It tells you the old assumptions are weakening. Stability is no longer the default. Volatility is. And once a market teaches participants that prices can reprice this fast, that lesson doesn't get unlearned. This story isn't finished at 117 or 100 or even lower. It's looping forward into the next test, the next shock, the next recalibration. And the people who understand that aren't asking where silver was. They're watching what the system does when pressure builds again. If you want to stay ahead of that curve, follow for what comes next.